Hello and welcome to this session brought to you by the Academy of Practical Accounts in conjunction with your institution. In this session, we're looking at the difference between cash and traditional accounting. Basically, our aim is to identify the difference between the two. The difference is not big. We only have one or two areas that are different. Now, cash accounting is where we exclude unpaid income and unpaid expenses. So we are saying that an income is recognized only after it's been paid for, and an expense is also recognized only after it's been paid for. Whereas with traditional accounting, we recognize income on credit, credit sales, and we recognize expenses incurred on credit. Now, one of the differences this creates is that with cash accounting, we don't have year-end adjustments like closing stock. So when stock is bought, it's recognized as an expense entirely at the time of payment. So there's nothing like this stock was not paid for. And this is aimed at simplifying self-assessment or small businesses whereby some accounting records are done by business owners. So they don't need to go into details of year-end adjustments, what is closing stock, prepayments, income advance, expenses in advance, etc. Those ones are excluded. Yet with traditional accounting, those year-end adjustments have to be made. So in traditional accounting, we recognize credit transactions. Now, another area of difference is to do with what we may call fixed assets that are used for only 2 years. Now, these fixed assets should include computers, and equipment, and vehicles, excluding cars. So, under the cash basis accounting, computers, equipment, and vehicles going to be used for only 2 years should be written off as expenses. In fact, in the next session, we're going to record the purchase of a computer, and that computer is going to be recorded as an expense, period. Forget about it at the time of purchase. Whereas with traditional accounting, these assets are treated as fixed assets. They are treated as fixed assets, which only turn into expenses using tax allowances and not depreciation. Remember, depreciation is not allowed for tax purposes. Tax allowances are standard depreciation methods or methods of writing off fixed assets, which are authorized and standardized by the tax authorities. Depreciation is very ambiguous and is disallowed. Okay, so now we are also saying that also legal costs for buying property and machinery that is going to last 2 years can be written off as expenses in the year they are incurred, irrespective of the fact that they are going to be used for another financial year. However, when it comes to traditional accounting, these legal costs are added to the purchase costs to come up with the cumulative value of a particular fixed asset. And they should only be written off gradually using tax allowances. Okay. Now, when it comes to bad debts, cash basis accounting, no bad debts are written off because there is no provision for credit transactions. There is no provision for credit sales. So, no bad debts. However, for traditional accounting, bad debts can be claimed because there is provision for credit transactions. And then finally, when it comes to cash basis accounting, now the business can claim a maximum of 500 on interest and bank charges. These are limitations being imposed on the business that is using the cash basis accounting for reporting purposes. However, for the traditional accounting business, there is no limitation on interest and bank charges. Although quite often bank charges don't rise so well, they could go beyond that depending on how often the business is using the overdraft facility. Okay, and also depending on how much money is borrowed by the business. But in the case of a business using the cash basis accounting, the maximum is 500 to be claimed on interest and bank charges. This could be a little bit confusing, but have another look at it. These are the conditions for cash basis accounting, and these are the allowances for traditional accounting. The question is, which one is better? This one only considers cash paid transactions. This one caters for credit transactions. And there's more room here. In this one, those assets to be used for only 2 years, they are written off as expenses. In this category, they only have to be written off using tax allowances. Well, that brings us to the end of this classification or differentiation between traditional and cash accounting. In case of any questions, please get us by email or Skype. Thank you.